Welcome to Algos with Garen. This is going to be episode 6 or 7, and I'm here with Dereck, the creator of the TQQQ strategy for the long term, which was showcased in the YouTube video, How to Make $1.4 billion in 8 years. And he posted this on Reddit. I found it through the Slack channel. And quick question, real quick, Dereck, are you in the Slack channel for Composer?
No, I'm not. I actually wasn't even aware that there was one. I'm not super familiar with all that stuff, so I didn't even know about it.
Okay. Yeah. Do you use Discord? I think they're about to start a Reddit, I believe. I've been talking to them.
Yeah, I do use Discord.
Okay. Yeah, I've been trying to talk them into starting a Discord and a Reddit, so hopefully that'll be fired up pretty soon. But yeah, let's hop into it. So I originally found your version 2, and how long have you been? I noticed you've been recording and posting on Reddit your trade summaries for the past 7 weeks or so.
That's about right.
Okay, how's that been going for you? How's the performance so far for this past 7 weeks been?
It's been good. So we're right in a choppy part of the market right now. Obviously, with the Fed meeting coming up and all that stuff, we're kind of having these real volatile days. So the year to date's been great as far as coming in, shorting the market, going to bonds, going back into TQQQ. So as of right now, I'm slightly, since starting that Webull kind of demonstration account, it's right around 2% profit, somewhere right there since the beginning.
Okay, that's not bad.
Yeah, not bad. It's like I said, it's gotten a little choppy as far as this last week has gone. So that kind of brought it back down to almost the beginning balance.
Okay. Are you using Webull to execute your trades, and you're just using Composer, or are you invested in Composer too?
Yeah, so I actually have my main investing money in Composer. The only thing I'm doing in Webull is demonstrating what the trades would look like if you're doing them manually.
Oh, okay.
So I'm using a Webull paper trading account and showing everybody on Reddit what that would look like as far as executing the strategy on your own. Let's say if you're not using Composer, what it would look like basically to demonstrate if it works or not. You know what I mean? You're always going to have people questioning whether it works, hindsight bias, overfitting, all that kind of stuff, which obviously I understand.
Yeah.
So yeah, doing the paper trading to demonstrate.
Yeah, the over fitting is interesting. It's hard to do really long back testing on Composer because we can only use ETFs right now. So how long have you been doing algorithmic programming? Do you do code at all? Do you do Python code, or did you just start with Composer?
Yeah, I started with Composer. So where I discovered Composer was I don't know if you follow him, a page on YouTube called Manio's Compounding Machine.
Yeah, I've been talking to him a little bit. He's in South Carolina. I think he might hop on for an episode, actually.
Okay. So I started following his YouTube channel, and that's where I heard about Composer. And so I went on the website, checked it out. I kind of was just self-taught. So I started messing around in Composer and kind of started putting in sort of basic trade strategies that I had learned from other investors that I follow. Chuck Hughes is a big one that I learned the 200-day moving average sort of strategy from. So I kind of used that as my baseline. And then I started messing with Composer probably back in February or so. And it took me months and months and months to kind of start seeing what was working and what wasn't. I had barely found out about leveraged ETFs back in October of 2021, and I figured, hey, this is great. I'm only 33, so I figured if I could invest in the leveraged funds in my younger years and maybe transition into less volatile stuff once I get older, then more power to it. I'm trying to make as much money as I possibly can while I'm younger, and I can endure the drawdowns.
Yeah.
And then later on, a transition to stuff that's not as prone to market crashes. You know what I mean?
Yeah. We have similar backgrounds, I guess. I originally started day trading back in 2017 on my main YouTube channel, and then I was trading leveraged ETFs, so I was familiar with them, like JDST and Gush and Drip, which is natural gas, and gold and silver and all them. But
Right. Yep.
the risks, one of the major risks that a lot of people aren't familiar with on leveraged ETFs is leverage decay. Are you familiar with leverage decay?
Yeah. Yeah.
Okay. Yeah. So that's one of the things that I was kind of leery about if I was ever to long-term hold ETFs. But the thing with Composer is you can program the momentum using like a 10-day drawdown or a 20-day drawdown or a 200-day move average momentum strategy. So you can really maximize the returns on those leveraged ones and turn them off when the market starts to go risk averse. But so what kind of clicked for you? I'm going to flip my camera around and kind of take a look at your code again. I probably should pull up my Miro. Did you watch the full video that I put down on your strategy?
Yeah, I did.
Did I explain everything correctly? And like, was my explanation correct to your thought process, or was there things that I was incorrect with?
No, I think you explained it pretty well. The whole thought process behind it. Well, do you want me to start as far as what my thought process was for building that?
Yeah, go ahead and start with it, whichever way you think you should start. This is your creation, so tell me the story on it.
Yeah. So, like I said, I discovered leveraged ETFs back in October last year, and I thought, hey, this would be a good way to make money long term. That was before I knew about volatility decay, all the other drawbacks that come with using leveraged ETFs. But the more I looked at, I didn't even know how to use charts. So the more I looked at the history of the TQQQ, the UPRO, just the stuff that was tied to the overall market as far as the S&P 500 and the NASDAQ goes, the more I figured, okay, especially the S&P 500, if the S&P 500 has been in existence, really back to, I guess, the 1920s, somewhere around there, maybe before.
A little bit. I think it was the 19 teens, but they didn't really collect data back then.
Yeah. Okay. Yeah. So I started following a couple of guys on YouTube, Stockmo and Stock Up with Larry Jones. And I was just watching their channels because I thought, there's got to be more to just putting money in an account and then watching it just drop in market crashes. You know what I mean? So I kind of got sick of watching my 401k just dwindle down and dwindle down, Yeah. So for me, I was like, I know there's guys out there making money during crashes, and how can I get in on that? Is kind of what my thought process was. So
did you happen to see episode 1 that I put out on the 30-year commodities and equities cycle?
Yeah. And that actually helped me a lot because I don't really understand how commodities work. So I understand they're sort of inverse correlated with the overall stock market, but I don't know how to implement them into long-term investing. And so that's why I stayed away from commodities in the strategy, because I only wanted to stick with what I understood.
Yeah.
So that's why I stuck with the S&P and the NASDAQ. So
yeah.
The more I looked at charts and I studied them, I understood how candlesticks, what the wicks were, what the tails were, all that stuff, moving averages, all that stuff. I just learned like a year ago. I'm pretty new to.
Well, you've done a lot of advancement in a year's period. That's a lot. It took me. I've been doing it for 5 years, and I still am learning stuff every day.
Yeah, and I'm definitely learning stuff for sure. So for me, yeah, I found TradingView, and that's where I started learning how to read charts. So when they started talking about, there's so many channels out there that talk about the macro sections of the market. But for me, it was, I basically was staring at charts and trying to figure out, okay, where's the trend and how do I capture the trend? And so obviously anybody can make money in a bull market, right? It's, you don't have to be a genius to throw money in it. It's going up and voila. So, and that played out with cryptocurrency. Everybody was making tons of money, obviously, up until
Yep.
up until January this year. And then obviously they said, screw it, I'm out. You know, it's going to zero, blah, blah, blah.
Did you get into any crypto?
Yeah, in October, I did a little bit. I got into Shiba Inu. You know, of course, I was buying all the hype and stuff. I didn't understand the market, didn't understand how it worked or anything. So threw money in it. It went up, came down a little bit. And I was like, okay, I don't understand this. I'm just going to take my money out. So luckily I did, because, you know, now it's way down there. But I did figure out that cryptocurrency, it pretty much is going to do whatever the NASDAQ does. Just
It's a heavily correlated tech asset. Yep.
Yeah. So just in larger waves, right? So you can see 10, 15, 20% moves in a few days, and that's not uncommon. So I figured, okay, it's just another version of the stock market.
Basically like a 5X of QQQ.
Yeah. Yeah. So what was funny to me is it's like everybody, you know, if you go, or if you just type in TQQQ on YouTube, there's, you know, 8 out of 10 videos are going to be, don't do it. It's not for long-term. Volatility decay is going to destroy the investment, blah, 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 blah. And I kind of bought into it at first. And I was thinking, okay, I guess that was a zero. So, but when I started looking into it, reading charts and figuring out, well, there's SQQQ. So if there's, you know, if I could buy one or the other when the market's going up or going down, you can make money both ways. But it's really figuring out, how do you capture the trends? For me, I'm not so much into day trading because I work a full-time job. Like I can't sit in front of the computer. You know what I mean?
Yeah.
I'm a technician. So I'm not at a computer all day.
Yeah, I can attest for that. It's exhausting. I used to do it, and that's why I switched to this algo trading, where I can just turn it on and let it go.
Yeah, and I just figured, these big firms on Wall Street are trading with robots essentially, right? You know, it's not like these guys are punching in keyboard numbers and making manual trades and stuff. I'm sure that goes on, but a lot of it is algorithmic. And so I just happened to stumble upon Composer. So like I said, I really was staring at the charts, and then I knew what the 200-day moving average was. I was using the 200, the 100, the 50, and the 20. And so when I put all those indicators and I put the RSI on my screen in trading view, it kind of gave me a much better picture of what the market does. So and the MACD too, but obviously you can't use the MACD in Composer. So I figured, why even?
Yeah, I hope they eventually release the MACD. I never really used it in day trading, but I'm familiar with it, and it does have some interesting strategies if you learn it. Did you happen to do the color coding with your charts like I did in a few of the other episodes? So easier to see.
I saw that. Yeah, I saw that you were doing that, and it actually helped a lot. I didn't think about color coding it like that, other than I was changing the colors of my moving average lines. That was really about it. My actual candlesticks, I just have them set to red and green with black outlines, and then I got my moving averages on the screen are different colors, and that's really about it. I wanted to create something that was simple, using simple data that I could invest in long term, to where basically if we're above the 200-day moving average, great. We can park the money there and just kind of ride that wave.
Yep.
The complication was what to do once the market starts to turn around and crawl over, where it goes below that 200-day moving average. Then all the FUD comes in, right? The fear, uncertainty, doubt. So I wanted to figure out what to do once the market is trading below that 200-day moving average. And so
how far did you go back? Did you go all the way back to I'm assuming 2008, 1990s. Did you go into the 70s and just looking at like the trend and how it moves to design it?
Yeah, I did that after I made the strategy. So because for me, I was, in 2008, I was 18 years old, 19 years old. So didn't have a 401k, didn't invest in stocks. The only way I knew there was a crash was because I lost my job, right?
Yeah.
That's most people.
Same.
So yeah, so what I did was I looked at this year because we've been under that 200-day moving average pretty much since the end of January, somewhere in February. And then once I started watching more videos on leveraged ETFs, that's when I started going back and looking at the 1970s, the 1987 Black Monday, like you mentioned in your video. And I was looking at 2008 too. So when you're looking at those charts, there's periods of time where the market is well below that 200-day moving average, and it's there for sometimes a year, year and a half, 2 years, you know.
Yep.
And then specifically, if you look at the 1970s right here,
yeah,
the markets, the macro movement is basically sideways, right? So, you know, if you're a buy and hold person, you're just getting wrecked. And that's what I wanted to stay away from, was just buying, you know, if you got a 401k, it's basically buy and hold. You're dollar cost averaging into it, but you're going to be waiting years for those drawdowns to come back and break even, right?
Yep. Yeah.
So for me, I didn't understand RSI until I was listening to Larry Jones and Stockmo, and they were bringing up RSI and talking about how the market's oversold, it's overbought, you know. Above 70, it's considered overbought. Below 30, it's considered oversold. So I really started to look at periods of time where the market crashes and figure out, okay, when is the market oversold, and does it rebound once it is oversold? So at first I was using the 14-day RSI to look at those oversold or overbought periods. But I noticed when using the 14-day RSI, it was few and far between where you could capture those moves, those rebounds, those quick rebounds.
Yeah, the shorter you drop the RSI, the quicker you'll have that, but you'll also have more volatility in your strategy. Or if there's a hard run one way or the other, you can get kind of demolished. Like if you have a multi-day explosion for some reason, but you take a short position because it's a short RSI, it can kind of hurt you. But you can also use a very long RSI. I've been experimenting with a 50 and a 100 RSI to where you can use that as a overbought, oversold long-term strategy. And also rolling returns. There's an indicator. I don't know if you saw me put this on here. It's called rolling returns. And I haven't done it yet, but you could, this is something I would like to experiment with, but you can see here in the rolling returns, we have pretty much anything over 40%. This is a 600-day rolling return, so it looks back 600 days. And it seems like as soon as we start touching above 40%, you probably have a market crash and a come down. So you can leverage into positions when the returns are like -20, and you get that high-end long-term return. But that's just an idea to throw at you if you want to experiment.
Yeah, definitely. And I actually got the idea from you as far as using those longer periods of time, that 600-day, the 300-day. Before that, I was really only focusing on that 200-day just because that's what I knew. But I have been experimenting with that. The other thing I did experiment with too, and I did create a strategy for it, and it panned out pretty well. But like you said, you can only back test so far, was the 35-day RSI for I believe it was UVXY or TQQQ. I can't remember which one I used it for.
That's a good one. I use that one a lot. I actually just designed, I haven't released the episode yet, but I just designed a volatility hedge that's inside of the SPY minimum drawdown. I'll show you, I'll give you a sneak peek of the next episode that's releasing this week. But it's got a drawdown of only 10%, an annualized return of 24% or 25%. But what were you saying while I find this?
So with the RSI, I wanted to find something that would sort of bring down the volatility a little bit when I was trading above the 200-day moving average. So basically, I didn't want to just be in TQQQ 100% of the time, because obviously, especially with the last even 3 or 4 years, if you look at 2019, 2020, 2021, there's a bunch of times where TQQQ is just ripping, right? I mean, it's far above the 20-day moving average, and it's way up there. So looking at the charts, if it's way up there, you know, it can come down a long ways before it even touches the 200-day, right?
Yep.
So for me, I was trying to figure out, okay, how can the VIX moves in such huge ways in such short periods of time. There's got to be some way to where you can capture those spikes in the VIX, right?
Yep.
So for me, I actually at first I thought, well, the VIX spikes the most when we're in a crash, you know, below that 200-day, maybe below 20. And it wasn't until I started doing the back testing where I figured out the best ways to capture volatility was in an uptrend, above the 200-day, above the 20. That's where you see these huge drops in 1 or 2 days. And that was a good way to capture it. So when I really started reading the charts on the VIX, what I did was I took TQQQ and then I overlaid it with the VIX or UVXY. And the reason why I picked UVXY is because that's also a leveraged ETF. So I figured, okay, if I'm using a leveraged ETF to invest with, and I want to capture volatility, the best way might be to use a leveraged volatility ETF, because in my mind, I was thinking they're probably closely correlated as far as
they're directly inverse. They're almost identically inverse and it can greatly reduce beta and drawdown if you do it correctly.
Yeah. So I was trying to find basically cousins or brothers, you know, as far as in leveraged trading. So for example, I didn't want to use QQQ, which is just a straight flat NASDAQ ETF, right? And then use UVXY, which is a 1.5 times leveraged VIX ETF. So I wanted to use stuff that was both leveraged or both not leveraged. So when I overlaid the UVXY with TQQQ, it gave me a really easy outlook as to, okay, when the market is in a certain position, you can see how typically at the top of the market for the NASDAQ, you can really see the VIX really start to kind of spike a little bit. And it's not until it's reaching 79.80 is where you can basically buy it, capture the quick moves before it rapidly drops again. Because the VIX, I mean, you can't stay in the VIX long.
No, it's very fast.
You can. Yeah.
That's why I like VIXM, VIXM. If you've seen me use that in strategies, if you look at that chart, the VIXM likes to spike and then go sideways. So it gives you a bit more stability. Here, I'll show it to you real quick. It's more stable. Like UVXY, you'll get a lot faster returns. But VIXM likes to spike and then go sideways for a while, and then it decays slowly. So you get these nice ramps. Okay. Whereas UVXY, it's literally just a rocket ship up and a rocket ship down.
Mm-hmm. Right.
But I found this volatility hedge. I redesigned the next episode, which the viewers will have already seen this by the time they watch this video. But it's called. I took Claude Constantine's minimum drawdown and I essentially modified every single piece. And this advanced volatility hedge is one of the first things that I build. And by running a back test on this, I was able to use the volatility hedge to reduce the drawdown to like 10%. It was actually like 9% or an 8% drawdown, and I upped the APY a little bit and floated it at about 10% drawdown. But this is the actual volatility hedge code. And it's very simple. This 5-day cumulative returns of UVXY is greater than negative 0.5. And then we do an inverse. I started experimenting with different ways I tried to do a sorting function, and I tried a few other things, but I found that an inverse volatility of 5 days between VIXM, UUP, and UVXY, and then the off strategy, when UVXY isn't running, the off strategy is we just rotate inverse between UUP and SHI. And this thing, it doesn't return anything crazy, but it's perfect for using as the inverse to movement of the market. And you can see it's almost the exact opposite of the SPY. So you can take this code and then plug it into anytime you have like a short function or a mean reversion on the SPY or QQQ.
Mhm.
this will be a really phenomenal thing to use to mitigate that. The
Yeah.
annualized return is like nothing, 0.7, max drawdown 3.3, but it, when applied into these strategies, it creates extremely stable drawdowns in the strategy, and you'll see it. I build it live in the next episode that's going to be released this week.
Okay.
But yeah,
Yeah.
UVX. I'm going to be experimenting a lot more with UVXY as far as building like a backbone of a strategy. I even
Mhm.
think that maybe this code alone, 5-day cumulative returns of UVXY is greater than 0.5. If you think about it, all markets, all the S&P 500 in the QQQ, if you look at markets as emotion instead of like logic and numbers, which is what most people think when they think the stock market, but if you really get down into the nuts and bolts, all markets are emotions. It's just mass millions of people and what they're thinking and contemplating. And UVXY is the realest data we have for fear and greed in the markets. So if you build a strategy around the first layer of market sentiment and then build upon that, I think that'd be an interesting strategy to get into.
Yeah. And the thing with the VIX too is, I mean, it's totally unpredictable, right? But if you can, the thing about the VIX is you can see it slowly start to, within just 1 or 2 or 3 days on a chart, you can see it start to build that momentum, right? And
Yep.
then it kind of takes off like a rocket. So
Yeah.
that was the only reason why. Go ahead. I'm sorry.
No, the charts kind of they kind of match the sentiment of media. So if you look this trend line on the VIX from December 2017, we had the big run up in 18 and a crash, and then we had COVID crash, and we just have this ramping up of fear. The VIX has not been decaying in fear, whereas if you look back here through the bull run, we had this divergence. We had this drawdown all the way since '08. The VIX has just been coming down because we're in a bull run, but psychologically people aren't fearful. We're in the bull run. The greatest times it's always going to go. That's the psychology of markets. And then if you look at '08 to '07, you have a very similar pattern where in 2006 we started having massive fear come into the market, but then we didn't have the major crash until 2008. So you see this reverse trend in the VIX where and then we have the .com boom. We have this ramp up of fear coming in from 1996 to 98, and then we have the big crash. And volatility, interestingly, never really spiked super high, but we didn't have a massive crash like COVID or 2008. But we're having that same pattern now kind of build, and we're getting to the tail end of these flags.
Yeah, I'm really interested to see what happens because it seems like we're going to be reaching a point of capitulation, right? And the market's it's going to go one of two ways. It's either going to break through that resistance line or it's going to break down and continue down. Now, as far as an investor goes, I think everybody knows, or the general consensus is that we're in a recession. That's obvious, but I think the hard recession is really probably not going to hit until maybe Q1 or Q2 of next year. We're just barely dipping our toe in, it seems like. But by the time the stock market bottoms, you're only maybe halfway through a recession anyway. So I think what a lot of people get wrong is they think the stock market hits a bottom at the same time that the recession hits a bottom, and that's never the case.
No, it's usually 6 months lag. So we hit the bottom, and then a couple months later, or even a year or two later.
Yeah. So for me, it's like, okay, I can't trade on emotions because I'm just going to lose money, right?
Yep.
You're going to buy at the top, you're going to sell at the bottom. So for me, it was really understanding the charts and figuring out, okay, where is the trend going now? Like I said, it's easy to put money in above that 200-day. Where I really was focusing most of my education and attention was how to capture those trends under the 200-day moving average, because people short the market all the time, and I need to figure out how. So I know they short it with put options and all that stuff, but I'm not educated in options, which is why I kind of stay away from them. I really only started understanding ETFs, and that's why I do them. As time goes on, you know, I'll get into options and all that stuff. But I know you a few times brought up the 10-day RSI sort function between the bonds.
Yeah, I thought that was a really smart way to do that. I noticed your shorting method here is the 20-day move average under TQQQ, and then you do a sort with RSI. So you're selecting if bonds have a higher RSI, you basically hedge, and then if the SQQ is higher, you take a short position. So you're not fully short the entire time. You kind of rotate. For why is that? Why not just go straight SQQQ? And
because the reason why I just didn't go straight SQQQ is because a lot of times and this will play out in the back testing if you look at it, is if you just go straight from TQQQ to SQQQ, there's too much volatility and you're just chopping sideways basicly.
Okay. So you're hedging that volatility. You're protecting on the volatility.
Yeah, because what I realized by reading the charts is even at the bottom of a crash, what happens is once you've truly reached the bottom, when the NASDAQ or even the S&P 500, when it closes above that 20-day moving average, once it's actually reached a bottom, if it closes above the 20-day moving average, now it may close above the 20-day numerous times before you finally reach a bottom. But what you'll see is once it closes above the 20-day, it never goes back until it crosses back up above the 200. That plays out in the 08 crash. It played out in the COVID crash. It could play out in the future. Even if you go back to the 1970s and the dot-com crash, once you reach the true bottom, when the market starts to rebound, it closes above that 20-day and it never dips back below the 20 until it reaches back above the 20 again. And you can see it right here in the chart.
Yeah, I used to see this pattern all the time in mid cap day trading. You'd have these breakdowns, and then you'd have the cross of the 20, and you'd take a long position the exact same way. It's a very, very common pattern. You just see multiple times in. Now you do have a bit more chop here during the 08 or during the 2001 crash. One thing you can use to reduce this chop is actually using. I noticed in your strategy, you use current price 200-day move average, and you use current price 20-day move average. If you want to,
I actually changed that. Now I'm using the SPY price, the 200-day.
Okay. You can slow down the volatility actually by adding in a small RSI. So if you use like a 4-day RSI or a 6 or even a 10, you have a bit more lag, and the response time isn't as quick with like your APY will probably drop a bit, but you're going to reduce the chop and volatility of those couple days. So you're basically looking at like a 4-day average. So even if you have 1 or 2 days that like spike up in volatility, you won't have a total cross. And I can kind of probably show you that. Let me turn on, I'll turn on the 6 and the 13. I think this is the 8 and the 13. And I'll change this to, we'll do blue. So yeah, you can see here it takes a few more days for the crosses to happen.
Right.
But yeah, that's one solution to reduce volatility as well.
Gotcha. Yeah, and so I actually figured out that sort function from one of your videos. So it might have been your first video I watched, but I didn't know how to use that sort function, which is why I didn't use it at all when I first made the strategy. And then once I plugged it in, below the 20-day in the bear market, I just happened to I used the 10-day because that's what I was used to, and then that's what was working for buying the overbought stuff to get into the VIX. So I figured, okay, let me try the 10-day RSI, select the best one. whether it's going to be SQQQ or BSV. So
Yeah, I noticed. Yeah, I noticed you've got TLC here in the second version, and you switched that up from the first version.
yeah, so what I did was I said, okay, is there something else I can add that maybe will help out the long-term growth a little bit so that we're not just bouncing back from one to the other? The reason why I chose TLT is because TLT will typically move upwards in a downward market, but not when there's high inflation.
Correct.
So, okay, so that's why I plugged in TLT to see if it would help out with the overall annual returns. And it did bump it up a little bit, and the drawdown didn't change. So I figured, okay, you know, I can leave it alone.
Yeah, if you want to experiment, you can use TMV, which is a leveraged version of TLT. I think it's a 3x or a 2x.
Okay, yeah, I didn't know that. I know there's TMF, but I stayed far away from that one only because of, you know, the hedge fundy's excellent adventure strategy.
Yep.
Okay, so I stayed away from TMF only because we're in a high inflation period and TMF is just getting destroyed. So I figured, well, let me stay away from that and see if that, and that it obviously works in a normal inflationary, you know, 3% a year inflation. It works well. But I just happened to start with the 3x leveraged ETFs because that's what I was most attracted to. But I did put together that other strategy, the QLD for the long term. I did, and I back tested that one through from, I think the earliest was maybe May of 2007, all the way through 2008, and it did phenomenal. I mean, it just by the time the regular S&P 500 recovered back to 0% from the crash, that strategy was already up in the hundreds of maybe 200%, something like that.
Was that the first one? Can we back test this first version to 2007?
No, because the 3x leveraged ETFs didn't exist until 2010.
Okay, so you tried the 20-day move average and the 200-day momentum, and it performed really well.
Oh yeah, for sure.
What were you were you just doing SH, or how are you taking your short positions, or were you just doing bonds?
So the short positions, I did QID, which is a 2x leverage of the QQQ. That's the inverse.
Tell you what, I got to restart the video or restart the Loom or the Zoom real quick because we're running out of time. But let's build that real quick, and I want to see it on screen. So let me shoot you another link. Okay, so we're gonna do. Will you tell me what to do? We're gonna do SPY 200 day.
So so to start off, do the current price of SPY greater than the 200-day moving average. I wouldn't do exponential moving average because it will make the returns and the drawdowns different.
Really? So so do you use a regular move average on your
move average? Yeah, just simple moving average.
Oh, okay. I didn't catch that. Okay. All right.
So yeah, do that, and then so now this one is going to have no VIX, no usage of the VIX. It's just going to be straight down market, up market without any volatility.
Okay. Is this next one a if function of the 20-day?
Let's see. Greater than the 200. Go to SPY. Actually, you know what? Change SPY to QQQ.
Okay.
Because we're still gonna trade the reason why I trade the NASDAQ is because better returns. It outperforms the S&P. It's the only reason why I do it. Okay. I'm okay with the higher drawdowns. I just want more money.
Okay.
So yeah, do the QQQ, and let me make sure on my side that I'm telling you the right way to do it. So let me minimize this a little bit. Go over here. I'm going to open my Composer real quick.
I assume you're just doing a QQQ 20-day. If it's down, bonds. If it's up, QQQ.
Yeah. But before that, I'm still doing that 10-day RSI.
Oh, okay.
Yeah. So let me pull it up here. QLD for the long term. I have that one, and then there's another one I made. QQQ since January 2007. You know what? I'll do. You want me to show you the QLD one or the QQQ one?
Let's do QQQ.
Okay, so I'll pull that one up real quick. Let me make sure I'm giving you the right parameters. Okay, so this one has so the rate of return was 45% and the max drawdown was 30%. I bet you could actually make that better because you're better at minimizing the drawdowns than I am. Because like I said, I'm just using simple information. So let's open this one. So yeah, it's current price of SPY greater than the 200-day moving average. Yeah, long QQQ, and that's it. And then so the next step would be the 10-day RSI of QQQ is less than 30. I'm buying QLD, so I'm just buying the 2x leverage of QQQ when it's oversold.
Okay. And then what's the next one?
The next one is going to be if the current price of QQQ is greater than the 20-day moving average, then do another if and statement. And correct me if you think or you can improve any of this. I'm gonna show you
move average or exponential move average.
Moving average.
Okay, 20-day of the QQQ.
Yeah.
And then if it's above, we're doing just a simple QQQ.
Do another if then statement. This is where I want to see if you can correct me on this because I think I could have it wrong here. So you do another if then statement.
Okay.
And you'll do if the 10-day RSI of QID, which is the inverse 2x leverage of the NASDAQ, if the 10-day RSI of QID is less than 31, then go long on QID. The else is going to be QQQ.
QQQ. Okay. If the 10-day is greater, so you could amplify returns possibly on this by doing QLD instead of QQQ because okay. So the theory is if we're below the 200 move average, we're short. We're in a bear market, and if we're above the 20-day, we're probably in that position in the market where we are
kind of ride that wave up a little bit.
Yeah, if we go back to 08, yeah, so like we're down below the 200 a little bit. So this area right here, it's probably better to take a 2x long position on there. Now that's not guaranteed. I would like to look back to the 1970s just to double check on that.
Okay.
Because yeah, so we would be 2x here, we'd be 2x here for a little bit, and then we'd be 2x here, which wouldn't be good. This is that chop that I'm talking about.
Yeah, that's that volatility. Yeah, exactly.
And this is where I'm be interested to experiment with like a very long cumulative returns, or a move average returns. Oh, I can't go back on the QQQ. NASDAQ. What's the old NASDAQ? Is it just DJI? DJI is not NASDAQ.
That's Dow Jones. The old NASDAQ is going to be NDX, I believe. But I think even that, it only goes to the 90s.
Oh, really?
Yeah, N as in Nancy.
NDX, NASDAQ 100, yeah.
Yeah.
Yeah, I think that started in the 80s, if I can't remember right.
Okay, yeah, I think you're right.
The only reason I remember that is because I watched an old movie where they were talking about the NASDAQ 100.
Right.
Yeah, we stop in 86. Yep, so just captured that. But yeah, it looks like it probably wouldn't be bad to have a 2x there.
There was a guy who is a coder that did code my strategy just using the S&P 500 and coded it all the way through the 70s, and it kind of did the same thing like it's doing this year. And when it like it did in 2008, it fell initially, because it was kind of following that 200-day, and then once it kind of broke below that 200-day and started capturing those RSI gains and then started to go inverse, is when it really started to kind of hit these large waves upward, while the rest of the market was crashing hard. It was pretty good. It did really, really well. Even through the 70s, it did extremely well.
Okay.
And he just used the normal S&P 500 numbers. Go up a little. Well, you go ahead and run the back test. Let's say go up a little bit. Make sure we have everything plugged in right.
Looks like it's pretty good. 47%, max drawdown 31%. I added a QID and a shy 10-day short, top one.
Yeah. Okay, perfect. Yeah. So QID, 10-day sort, shy, perfect. Yeah.
Oh
Yeah.
yeah,
See how,
that annihilated the '08 housing market
yeah.
crash.
Yeah. See, that's what I was, the whole reason why I made these strategies was to really, once the market really started to drop down, I'm trying to go the other way. You know what I mean? I'm trying to capitalize on these market crashes. And
Yeah.
that was the whole reason for the strategy. I didn't want to lose a ton of money in a crash and wait forever for it to come back.
Yeah, well, you built a beautiful strategy. This is a very very nice, very simple short strategy. I highly recommend you read if you haven't yet, Unknown Market Wizards, books yellow, chapter 8. He interviews a 20-year algorithmic trading investor, and he talks about his best and
Okay.
worst practices. It's like that's the first thing that I recommend anybody read when they come into algorithmic investing. But one of his core tenets is make 1,000 simple 1,000 simple programs. Don't make like super complex individual ones. And this is literally like the simplest you can possibly make it with amazing returns.
Yeah.
Um,
Yeah. And that was the whole idea behind it is, how can the average person out there create something that's simple and they know that they can invest in long term? That's really the only reason why I made it.
yeah.
3x leverage, 1x, it doesn't matter to me. I just wanted something that is not going to kill me long term. You know what I mean?
Yeah. I'm very
Go ahead.
I'm very interested to take your strategy, this strategy we just built, and experiment with this 5-day cumulative returns of UVXY and switching this up. So let me just do that real quick. I'm going to copy your whole strategy, and
Okay.
I'm going to take my volatility hedge, which right now the volatility hedge it's just kind of built to be inverse to the stock market, so you can use it as a protection. Are you familiar with the power of rebalancing and increasing annualized returns from rebalancing portfolios?
Yeah.
Okay. This is kind of designed around that, where it's every 8% it rebalances its positions, and it's basically using that as a hedge. I explain it for everybody that doesn't know or hasn't seen the episode previous of this. I explain it in that episode. But yeah, let me delete this, and we're just going to add this into the normal function when the UVXY is not running super hard, and see what it does.
Okay. Because you can't back test this through 2008, can you?
No, unfortunately not. Can't. Didn't do too great. I'll have to experiment with it. I mean, it's still positive. It's still max drawdown 26, 18% annualized.
Yeah.
But it definitely performs exceptionally well during the.
Yeah, that's great, man. When it looks like a ramp like that, while the rest of the market just goes in the toilet and you're making money.
Yeah,
that's great.
I've got another strategy. I haven't made a video on it yet, but it's a max volatility catcher, and I've been building it for a couple months now.
Okay.
You can really make some very interesting strategies when you start experimenting with volatility.
Oh, for sure. Yeah, like I said, once I figured out how to use it and plug it into Composer, that changed everything for me. Now, the one caveat, obviously, with the strategy that you saw was on the bear market portion, using UVXY above 74 but below 84. That's really experimental with me. I barely plugged that in within the last maybe week or two. So I'm willing to take that out of the strategy if it's not likely to perform. The only reason why I kind of left it in there is because it did so well with COVID, and I think it caught another spike either in 2018 or 2015. I can't remember, because in 2015 we had a really fast sudden drop, almost like 1987. Obviously not as bad, but over 2 or 3 days there was a massive drop.
Yeah.
So this is a black swan kind of catcher.
This is the fifth version of this. I'm still experimenting with it, but yeah, this thing does
crazy, man.
39% annualized return, max drawdown of 24, 825% gains through COVID.
That's insane.
Yeah, so $10,000 to $92,000. But I'm still experimenting with it, but it's going to be an awesome episode, I think. And it's really going to just be focused on volatility.
Yeah, man, when I saw your first video, I really enjoyed it. And you were the first person besides the Manios compounding machine that I saw using Composer and kind of pushing it to the forefront. Like, you know, this is one way you can successfully invest and not lose a ton of money and just being in a 401k or a mutual fund. You know what I mean? And I thought, I really feel like this is going to be a real big player probably within the next 5-10 years. I bet this will catch on with a lot of people.
Oh yeah.
And you're going to see a lot of crazy strategies out there.
If you look at the evolution of investing, I love the history. So do you know where technical analysis started?
No idea.
So it was a Japanese rice farmer in 1632. He would go to market every day, and he would record the high and the low and the opening and close of the day. He'd go home and he'd graph it out on graph paper, and over weeks, months, and years, he started to see trends emerge, and he used those trends to predict market movements. And basically, they estimated today he would have been worth $10 billion in like China. He had something that nobody else had. Like the first technical analysis. And people like to knock on technical analysis, that it's not. You can't fucking use technical analysis. You can see trends all the way back to the 1912s. Like you can see the super cycle of the markets. But if you study the evolution of markets or the evolution of investing, there's the first form is fundamental, like mathematics, doing math and doing the numbers on returns and all that stuff. And then in 1930s, the first EMA, the 200 SMA, was born. Hedge funds and big money started using the 200 simple move average. And then in the 70s, computers came out, and they had the first one was ticker tapes. So the tape. You ever watch the tape reading? There's guys that can actually sit there and enter and exit orders just on the tape. They're just called tape readers, and that was like the very first form of trading. Then we got the visual charts, actual charts data in the 1980s and 90s. And now we're getting into this new realm of machine building, which I think is just the forefront of investing. You know, if we were having this conversation back in 1930s, we'd be talking about fundamental analysis. If we were hanging out with the Chinese rice farmer, we'd be talking about the graphs. And then if it was 1980s, we'd be talking about charts. And now I think the forefront is going to be algorithmic investing, because it eliminates so many issues with emotionality. And
that's the key. Yeah. Emotional trading, I think, is what destroys most retail investors, because, you know, whether it's inexperience or they don't like seeing red day after red day after red day, they panic. It's very hard. Yeah. I 100% agree. And I think there's been definitely studies and data on this, but the average retail investor is making like a 2% profit per year because they're panic selling. You know what I mean? They're buying the hype and then they're selling. They're selling at the absolute worst time. Well, it's like that. Warren Buffett even says when there's blood in the streets, it's time to buy. You know, and it's like when there's extreme greed, time to sell. When there's extreme fear, time to buy. It's simple, but it's like, do you have the gut to do it? Right. There was one thing I wanted to ask you, because anytime you post something like this on a forum, obviously there's people that are stoked about it, and then there's people that shit on it, right?
Yep.
So for those guys out there that look at it, and I'm not saying it by any means, that it's an end all be all. I'm not saying that at all. I obviously am very aware of the risks, but for the guys out there to tell you, for you to think that this is actually going to perform better than the Medallion Fund, the Medallion Fund?
I've heard of it. It's probably similar to all the other funds that are really great. Like,
yeah. It's a hedge fund. Over 30 years, they've been averaging a 39% return for over 30 years or whatever. The only people that have access to it are obviously multimillionaires, maybe billionaires. I'm not really sure.
Yeah.
So what do you say to people like that that point out something very obvious, like the medallion fund? These guys have the best scientists, the best data guys, whatever, you know what I mean?
I know,
what is your response to people like that?
I know a guy that drives a 2016 Tacoma that does private equity, where he can get 50 to 100% ROI for 5-year periods through his investments. Like, I understand the average person, 30% APY is hard to do, and I understand the skepticism of algorithmic trading. The way I would approach that first is I would think, what's their arguments? Like, why would it not work and stuff? And the first thing is, backtesting is not indicative of future performance. We won't know. We won't know how these investments work. But the first thing is, it comes back to portfolio management. Again, it's better to have 1,000 machines that are running, that you've built customized, that you know how they're doing, than to have 3 investments that you manage individually. While your strategy might not return a 296% return over the next 10 years, it's going to return probably better than 11%. It will. And even if it doesn't, if you have a lot of machines, 100 machines or 300 machines that are running, you can use portfolio rebalancing to mitigate that drawdown and that risk. So that's the first thing. The second thing would be, there is a theory in investing where any strategy used too much will stop working. And there's strategies that were used in the 1970s that don't work now, and there were strategies that worked in the 1990s. So there was a 2-day RSI strategy that worked really well through the 90s, that no longer works today because people started using it a lot. So you will have to factor in that eventually the machines you build will not perform. The efficiency reduces over time. So you have an efficiency decay on the algorithmic machines you build, but you compensate for that by just continuing to build more machines and using the portfolio rebalancing. And eventually there'll probably be a period where old machines so let's say we fast forward and your strategies work really well for the next 5 years, and then they stop working because the market's changed, and that's going to happen. It will happen. It'll start underperforming or not performing as good as it did through the next 5 years or 10 years. But eventually the markets will return back to their cycle, and you'll probably see an outsized return. So your bots will they'll look the same as the market. They'll move up, and they'll be really great for a while, and then they're going to curl over and they're going to start not doing as well. But you can mitigate that through portfolio management. And there's different ways to do that. But yeah, it's a sound argument. Like, I understand why people would say, you can't beat the medallion fund and all that stuff, but you also have to understand the incentives and goals for people in the medallion fund. Hedge funds aren't designed to make 50% APY.
Maximize returns.
Yeah, if you want 50% APY, go private equity and get into that.
There's a reason why they call it a hedge fund, right?
Yeah,
they're just hedging.
Yeah, if you got billions of dollars, you the last thing you want is risk. You
Exactly.
You want 3% drawdown for the rest of your life.
Exactly. Yeah, absolutely. For me, the biggest thing for me is
here. Real quick, I'll let you go. This last one. The last thing I would say. Wall Street Bets is a very great example of the power of mass design. We're entering into a new age of creativity and distribution of information and decentralized design. Like, I can't imagine what Composer is going to be and the community of Composer is going to be in 2 years. If we can get even 10% of the people from Wall Street Bets to design symphonies and start applying their brain power to this stuff, hedge funds cannot compete with that.
Right. Well, and not only that too, there's a statistic out there that 80 to 90% of the hedge funds that are out there right now can't beat the S&P 500.
Well, their goal isn't to beat it either. Their goal is, I read the article that was posted in the Slack channel, actually. Really good article on the downsides of portfolio pricing for hedge funds. But if you're the hedge fund manager, your goal as the manager to make as much money as possible is the same as Jordan Belfort and brokers in the 90s. It's to get as much money asset under management so you can charge as much fee under management to make as much money for yourself as management. It's not to make outsized returns on your investments for your investors. There's a disparity between the incentives and goals of hedge fund managers and the investors. And they also, people that have billions of dollars have different investment outsets and goals than us.
Right. That's true. Yeah, exactly. And my whole thing is like, this is what I love about Composer. I'm a natural gas service technician. I'm not a programmer. I'm not a computer guy. Like, I'm just a normal average person. You know what I mean? So for somebody like me to be able to use a site like Composer and build strategies that I don't have to manually trade myself and that will outperform, at least for now, you know what I mean, to make me as much money as I possibly can so that I can put that money into real estate investing or whatever goals you have for life, right? You want to start a business or whatever. This is a great way to almost, I hate to say put it on autopilot, but at the end of the day, that's what it is. So it's a good thing for people like us that, well, I don't know what you do, but people with a 9-to-5, they don't have to sit there and track the market every single day. It's making the trades for them. You know what I mean? Whether you're making 10% or you're making 40%, it doesn't really matter. The fact that you have the ability to do the algorithmic trading, I mean, you're already better off than most people in history.
Yeah.
Even if you worked on Wall Street in 1980.
Yeah. Yeah. And I think the best thing too is the knowledge and the education. Like when you start building these machines and you understand how they work, you learn. It's the most intuitive way to learn the markets and learn how money moves through these systems, which when things go wrong or things don't work the way that they thought they were going to work, you have the level of education to understand what's going on.
Yeah. And my takeaway is that the whole reason I did this and posted it on Reddit is to just show people like, look, this is possible. And it's not at the end of the day, the strategy is really not complicated. It's trade with the trend and buy oversold or overbought. That's pretty much it. I mean, that's really what it came down to. Yeah.
When you read Market Wizards, Chapter 8, he talks about it. He says, every great strategy needs to have an on-off switch for momentum and then mean reversion of some sort, and it'll typically outperform the stock market. And I didn't even know what mean reversion was until you made the video, and I was like, okay, that makes sense, you know. But again, I'm a technician. I'm not you know what I mean? It's like, I don't watch CNBC every day. You know what I mean? Not saying that you do, but you know, a lot of people out there, analysts or whatever, they like to use. That's the other thing, you know. People in the industry, they like to use all the fancy terms. Oh, it's transitory, this and that. That's just jargon. So people like me and you don't trade in the market, right? Yeah. So those guys can keep making money. So, one of the best lessons I learned from the 5 years I've been studying investing is don't be in chat rooms or don't watch the news. If you want to have a strategy for investing, whether it's manual trading, swing trading, leveraged ETFs, or long-term investing, or dollar cost averaging, the best way to handle it is to be completely isolated and just learn the market yourself and watch the market and pay attention to the news a little bit here and there. Like, obviously you got to pay attention to the Fed's increase in interest rates and stuff like that. I think the Fed's with the interest rate is going to have the biggest impact over this next coming year or two. There's two theories laying out. There's a theory that, well, they're coming out with more stimulus, which is going to raise inflation. I've got an inkling that maybe this pull down, this past drawdown, I don't know if it's the start of a recession or a depression, or if it's just the first leg pullback on a massive inflation flag that's just where it's just gonna reverse and rip to the next fucking moon. But we'll see. Who knows? Nobody knows.
Yeah, honestly, for me, as far as looking at charts and looking at all the economic data, you know, with employees starting to be laid off, and
it's not looking good.
The housing market's already starting to tank. The one thing we have left is the unemployment rate. So once the unemployment rate starts to tick up, you're going to see similar moves. I'm not saying it's going to perform exactly like it did in 2008, but we've already been in a market downtrend since January. So that was the whole reason why I got into this. It's like, okay, the market's been moving down for 6 months. How can I make money instead of just continuing to lose money? You know what I mean? That's all it was for me.
I'm glad we had the COVID collapse too, because like that gave us data for Black Swan event to design strategies around. So we have another point of indication. Have you ever seen this chart, the emotions of market movements?
No, I don't believe so. No.
This is a psychological chart, and this is kind of one of the first charts I use to teach people about markets before I even get into technical analysis. Instead of looking at the charts and stuff, you pay attention to the masses' emotions towards markets. So you were 18 years old during 2008 when the housing market crash happened.
Yeah.
You remember in 2011 where people were just protesting Wall Street and pickets.
Occupy Wall Street.
Yeah. Everybody was angry. Like you see these emotions in the markets. Yeah. Euphoria was, a year ago with Bitcoin.
Going up, it's never going down.
Yeah. So you belief, thrill, euphoria, complacency, anxiety. Why am I getting margin called? The dip is taking longer than expected. We just need time to cool off for the next rally.
That was me in February of this year, anxiety. Buying that TQQQ thinking it's going to bottom at some point.
Yeah. And then the last one's capitulation. I'm getting 100% out of the markets. I can't afford to lose anymore. And then it gets even worse. And then we usually have a long sideways period of consolidation. And you especially see that in Bitcoin. Well, you see it in every market usually. If you go to, let's do BTC. Oh, if I can type it right.
You missed the T. Yeah, you missed the T there.
If you look back at the historical data on Bitcoin, which is really just a leveraged version of tech, it's financial tech.
Yeah, exactly.
You see these massive run-ups. Let me turn off logarithmic. You see the massive run-up and collapse, and then it goes sideways for a while. And this is when everybody says it's trash and it's not going anywhere. It's worthless. And then the next one, it's literally the exact same pattern every single time. So we've still got some time for it to go.
That's so interesting.
Sideways.
Yeah, and same thing. I was skeptical to get into crypto. I didn't understand it, and then once I started actually looking into it, it's doing whatever the stock market's doing, just on a larger scale. Yeah. Solana and Ethereum, and even Polygon have been doing actually pretty well, even in this last week or two. They've been shooting up while the market's going down. But I know it's short-term moves, but they're doing really, really good. So I plan on investing in those long-term.
Yeah, I'm completely out of it right now. But the first time I got into Bitcoin was actually back during the first collapse here. I dropped 30 grand in on this flag pattern because I knew from technical analysis and the fact that it dropped 50%. I was traveling a lot, and I just heard in the news that it crashed to $30,000, and I was like, I'm going all in on this. I know it's a really good risk to reward. And then I should have took more profits. I got euphoria hit me a bit. I took 35% profits here, and then I took the remainder down here, and then I got out like a day or two before the Luna collapse. But I'm completely out right now. But there is actually a Bitcoin algorithmic strategy that was built and uploaded. I don't know if you've seen it. I'll send it to you.
I'm not aware of any.
I'll link it. I'll link it in the description and send it to you. But I think your strategy would work perfectly for Bitcoin as well. I mean, the 200-day move average and 20-day move average, it's pretty similar. Might have to change it around a little bit, but yeah, you can see it's pretty. I mean, it looks the same as the stock market. You're under the 200 or under the 20, and then you're back up above it. Then you're below it. You're taking short positions, and then you just got to rotate once you cross the 200. Yeah,
I think as time goes on too, Composer, they're obviously going to add more features to the platform as far as how you can build your strategy, because there are times where I'm like, man, it'd be great to take some profits, but there's no way to really take profits unless you just basically take some cash out of the strategy, basically,
Yeah.
The only reason why I added that SQQQ below its 31-day RSI was to that is acting kind of as a stand-in for taking profits. So what I mean is, if the TQQQ closes above the 20-day and you're riding that wave up, at some point it's going to be overbought, right? And then it's going to start its next downtrend. So that's why I added in that 10-day RSI of SQQQ is less than 31. Go to SQQQ. I put that there as a way to sort of take profits on your TQQQ reaching
Yes.
70 RSI.
That's a very smart way to do that. You'll see that exact same method in my black swan catcher. So this thing uses the exact same strategy.
There you go. Yeah.
Well, we've only got about 7 minutes left before we wrap this up. Do you have anything to say to like new people coming into this stuff, or any kind of recommendations on getting started, doing more things you've learned, things that are important to know?
Yeah, the first thing I would say is, if you're new to this, have everybody's got an idea in mind of how they would like to invest in the market. So take your idea, try to implement it into Composer, and see if it works. If it doesn't work, that's where you start making really small adjustments. That's how I started with it, and over 3 or 4 months it turned into this. So my biggest piece of advice is, have something in mind that you think might work, and then learn how to use Composer, plug it in, see if it works. If it doesn't, tweak it one by one by one. The second thing is, if you're emotional about putting your money in the market, Composer is a really good way to hedge your emotions, because it's going to make trades whether you want to trade or not. And it's based off your strategy. I think the biggest thing, this is my third thing I will say. If you already have a strategy that you want to implement it and stick to it. Because the biggest thing, and I've noticed from people sending me messages on Reddit and stuff too, as soon as the market starts to take a turn, they start to get iffy about, is it going to work? Is it going to work?
Yeah.
I'm telling you right now, if you have a strategy, stick with your strategy.
Well, I think that I should segue on that. You should never invest in a strategy you don't understand. One of the reasons that I built every strategy that I have money in, I've built myself, or I've gone through and modified it. I don't think it's good to start by jumping on the community page and using the ones that they have on there. But the point, it's a general rule of investing anywhere. It doesn't matter what kind of investing you're doing. You never put your money in something you don't understand, and don't ever trust somebody else with your money if you don't understand what they're doing.
For sure. And that was the whole reason why. Yeah. Well, and that was the whole reason why I did the Webull demonstrations, is just to show people, this is what it looks like trading it in real time, doing the trades yourself. You know what I mean? It's really just to show people, if it works, cool. If you want to do it, cool. If it doesn't work, no problem. You know what I mean? No harm, no foul. But yeah, one big thing too is never invest more money than you're willing to lose. If you got $100 to throw at a strategy, throw it at a strategy. See if it works. It's going to take time, though. Any investment strategy is going to take time to prove itself successful. You can't throw it in for 2 weeks and then say, shit, it's hopeless. You know what I mean? It's not going to work.
Especially if the strategies you're investing in have like a 40 or 50% drawdown. You might accidentally invest in the high end of a drawdown, and then you're down 50%. So that's another thing too, is you want to dollar cost average into your strategies. When I invest in strategies, I drop initial money in, and then I will drip feed in another 10% here, 10% there every week or two for the next 5 months or so. So that way you're averaging out your entry in case you accidentally invest into the high side of a drawdown.
Yeah, definitely. And you can see that pan out if you go to Portfolio Visualizer. You can go in there and click on I think there's a link called Market Timing, where you can compare a buy and hold strategy to a dollar cost averaging strategy. And especially if you start from before the .com crash, the dollar cost averaging, I mean, that is going to save you in any market crash.
One thing I would love to see for the Composer creators that are watching this, I would love to see a range in the back testing. So I would like to see like a spider web of probability risk, like probabilities of instead of one single line here, I would like to be able to say, hey, I would like to know if I invest from Tuesday, September 7th, or all the way through to September or October, like a 2-month range, I would like to see a spider web of the average return that's probably going to happen, because depending on the day that you invest in, if you invest on the wrong side of the drawdown, you can see the strategy is moving. You're getting from here to here. You're going from a 600% return to a 500% return, and it's fluctuating. So it would be nice to see a range of a ribbon, essentially, instead of just a single line.
Yeah, absolutely. Yeah, and just to close it out, first of all, thanks for even responding, because a lot of people, they won't even respond. So
I've seen the comments on Reddit.
Yeah. So, thanks for actually taking the time to sit down and talk about it and figure out what the mindset is behind the strategy, because I'm not just looking at charts and trying to cherry pick the information to make the highest return.
It's really not. It's not overfitted at all. It's really not.
And that's the number one complaint that I get from people commenting is recency bias. It's overfitted. It's overfitted. Okay, can you tell me what's overfitted about it? And
they just see 2014 and they're like, oh, it's overfitted. It's you have it back to
right, yeah, exactly. Well, because for somebody that's out there, they're going to look at that and say, well, we've been in the biggest bull run ever for the last 13 years. And you know what I mean? And then they just kind of write it off. Yeah. It's like,
but here's the COVID collapse, and we profited it, and now we're still profiting.
Exactly. And then I even showed them the 2008 financial crisis, and it did phenomenal there. So it's hard to.
I'll make a dedicated video for your simple strategy, and I'll just be like, here's how you beat the housing market crash.
There you go. Yeah, exactly. Yeah, and it's a lot of fun too. I mean, my wife and I put our kids to bed, and then I kind of play around on Composer for like 2 straight hours. You know what I mean?
Yep.
When watch the TV, she sits right next to me, and I just mess around.
Yep.
That's how I built the strategy.
Well, it looks like we got about 1 minute left, so it's about to close down. But yeah, I was the same way. When I found Composer, I sat for a week straight and just like built strategies, because I had all this back knowledge of like 5 years of technical analysis, and I just. I think I lost your audio. We're about done though. Yeah, your audio is gone. I don't know. Well, it was nice talking to you, man, and thanks for coming on.
Yeah, you too. Yep.